Hey, thanks for tuning in to Loans with Chris. I'm Chris, and I'm an independent mortgage broker, and I'm back with another edition of video for you as a consumer out there learning more and more about home loans. Today, we're going to talk about 4 common down payment myths. Let's just hop in. The first one, myth number 1, you need 20% to put down on a home you want to buy. Not true. Here's the thing. Back in the day, 20% down was a common down payment associated with a 30-year fixed mortgage, and it was really all that was available. Well, times have changed, and now there are lots of options available to home buyers, and so 20% down isn't necessarily all that important. Now, you can still put 20% down on a home if you want, and it's going to improve your terms a little bit, maybe give you a little bit of a lower interest rate. Most definitely it's going to give you a lower payment. But as a professional, I'm usually of the mindset that cash is king. So if you can save some of your money, that's going to be a win-win. So it depends on what kind of a loan you're doing, the minimum down payments. But let's just jump into a few real quick here. On a VA loan, if you're not including people that aren't spouses, etc., or buying by yourself, there's 0 down required on a VA loan. That's pretty cool. One of the biggest benefits, I think, for a veteran to be able to exercise his or her right to own a home or finance a home through the VA. Very cool loan. They come with really, really low interest rates, and they're very popular and great loans. I love them. I support them 100%. And thank you to our veterans for your service. Okay, so conventional loans. If you're a first-time buyer, meaning that you haven't owned a home in the last 3 years, you can use a first-time home buyer's down payment program, which is going to require only 3% of the purchase price. Now, if you're not a first-time buyer, meaning you own a home now and you're buying a new primary residence, or you sold a house recently in the last 3 years, you still only have to put 5% down. That's the minimum, and that's pretty cool. And again, cash is king, so maybe you can save a little bit of your capital. And then there's FHA loans. FHA loans are going to be great because they have a lot more flexibility for home buyers out there. And FHA loans only require 3.5% of the purchase price as a down payment. Another really great option. But again, let's debunk the myth of a 20% down needed to buy a home. It is not a thing anymore. Unless you're buying a rental property, in which case, yeah, you're going to need 20% down. But for a primary residence, no, it's not a thing anymore. All right, myth number 2. Paying PMI is always smarter than making a large down payment. Now, PMI serves a purpose, and it really supports and covers the lender's risk against loss. Now, PMI is not necessarily a great option. It just depends on how much money you make, how much of a payment you want. It can be good. It serves a purpose, but if you have 20% down and you want to avoid paying PMI, well, then that's a great option for you. Now, there are a couple of other options. One I'll talk about here, and that's called a lender-paid mortgage insurance. Now, if you have really good credit and you don't want to have a monthly mortgage insurance premium, you can take a slight bump in interest rate, an increase in interest rate, to buy out that mortgage insurance, and that means that you won't have to pay it on a monthly basis. Now, your loan officer, hopefully you're working with an independent mortgage broker, and we're going to take the time to determine the best options for you, weighing everything out. How much money do you have? What is your threshold for a monthly payment? Do you make too much to, benefit from the mortgage insurance deductions you might get, which aren't as great as they used to be based on new tax reforms, but there still might be a benefit. Your loan officer, with your help, is going to determine the best option for you regarding mortgage insurance, down payment, or lack thereof. Myth number 3. Your down payment is the only money you need to bring to the closing table when you buy a house or refinance. And unfortunately for you, it's not. There are also closing costs. Now, down payment is going to determine the loan size, and if you're refinancing, it's equity in place of down payment. And that also determines the type of loan that you can do. But there are closing costs. And closing costs come in a couple of different buckets. There are 2 main buckets, and they're called recurring and non-recurring. The non-recurring are the one-time closing costs that you really can't recoup and they're not really your money. They're going to third-party entities to cover things like processing fee, maybe an underwriting fee, credit report, an appraisal on the property that you're financing, title and escrow fees, and because they need to ensure that the property is clear of liens and other clouds, if you will, on the title of the home itself. And it benefits you, but these fees are attached to a home loan as well. And then there's the recurring fees, a second bucket, which are going to be your prepaid interest, your prepaid taxes, and your prepaid insurance. Now, your prepaid interest is going to be important because you're paying a loan in arrears, which means you're paying payments after the fact. And so therefore, you're going to have to pre-fund some interest on the loan from the time it closes to the time of your first payment. Prepaid taxes and insurance are great if you're doing an impound account. If you're not, these aren't even really a thing for you. In the closing costs, they don't exist. But if you're using an escrow account, meaning that the lender is going to make the homeowner's payment and the tax payments for you, you have to pre-fund that account. You're going to pay into it monthly as well, but there's a formula that sort of determines how much is needed up front in order to be able to have enough money in the bucket when it comes time to renew the homeowner's insurance or pay the semi-annual tax bills that the lender will do for you. You'll still get copies of the bills themselves, but you don't have to take them out of your pocket. You've really already paid for that. But again, if you're not doing an escrow account, you're going to pay these bills on your own, and you're not going to have to pre-fund that into a loan at all. But that is also going to be important to know. Now, closing costs can be paid out of pocket on a refinance. You don't have to include them in a loan, but when you're buying a home, you cannot include down payment or closing costs into the loan. They have to be paid out of pocket at the time of close. Myth number 4, down payment assistance is only for first-time home buyers. Now, at the time I'm making this video in 2020, August 2020, in California, you may even see ash falling. Literally the entire state is on fire. The sun is orange. It's yucky. I've got ash. It looks like the sun is snowing. But we're, while the state is on fire, we're in the middle of a pandemic. Unfortunately, I'm in my yard where I'm in full privacy, but COVID-19 is going on right now, and I'm really hopeful it ends soon and we get back out to the world, and everybody can get back to work. And if you're struggling with that kind of stuff, my heart goes out to you, my family's does too. Let's get back to business though. Down payment assistance is only for first-time home buyers. Now, along with the sort of pandemic and times we're in right now, a lot of the down payment assistance programs have been put on the shelf, meaning that lenders have not been able to use them, or they're not available right now to you. There are a few. They're not the best, but there are some good ones out there, and they do serve a purpose. Now, the myth itself is based around these down payment assistance programs only being available to first-time home buyers, and they're not. They're not always. Some of them are, some of them are not. Now, a first-time home buyer, in short, really only means you haven't had ownership interest in a home in the last 3 years. That's it. But sometimes these programs allow people that have owned a home in the last 3 years to still qualify for the down payment assistance under other circumstances. Maybe there are income limitations or other things. But down payment assistance programs are not only for first-time home buyers today. So if you have a need for some down payment assistance, talk to me or another independent mortgage broker, and we'll help you determine the best options for your next move with regards to a home loan, whether a home purchase, or if you're refinancing. Really, down payment assistance isn't even a thing because you're leveraging the equity in your home. So thanks for tuning in and listening to me talk about the 4 myths. If you have questions, please feel free to subscribe, comment below. I welcome the conversation. I'll respond to your comments. And if you'd like to reach out, my contact information will be available. And until we speak, keep up the good work.